Hello, and thank you for joining us. I'm Nick Elliott, Head of Communities at Dow Jones Risk and Compliance, and I'm very pleased to welcome you to this second in our series of webinars looking at risks in corporate sectors. We recently looked at energy. Coming up next month, we're looking at manufacturing, but the topic of discussion today is banking. We launched this series in conjunction with a new research series where we use our Factiva product to analyze what companies themselves are saying about specific areas of corporate risk. And to understand the risks in the banking sector, I'm joined today by a special guest speaker, Rosamund Sybel, Head of Geopolitical Risk and Financial Crime Compliance at ICBC Standard Bank. She's talking today, though, in a personal capacity. Rosamund, thank you so much for joining us. And I think it's especially apt that we have you as a speaker today, because what we found in the research report was that geopolitics was the top mentioned risk among banks, but also it's a rising risk. Can you explain why geopolitics is such a risk issue for banks?
Sure. Thanks, Nick. Look, geopolitical risk has always been an important factor for the banking sector. It's a key driver of market risk, trade relations, capital flows, and also regulation. But what's really changed in the last few years, especially since the invasion of Ukraine, is that geopolitics has become a far more central focus. So being glib, if you're a decision maker in a bank, what section of the Financial Times do you turn to first? I mean, maybe a year ago it was the companies section, but today it's current and world affairs. It's the front end of the paper. And that's because understanding what's behind those headlines is what's driving banks' risk appetites and strategies. So the banking sector is adapting to this era. You know, it's an era that's characterized by greater political and geopolitical volatility as the world shifts away from a US-dominated unipolar world order. And there is a symbiosis between the geopolitical picture and the global economy. So there's greater protectionism, more geoeconomic fragmentation, new blocs and alliances are forming. And this, of course, has a set of direct and indirect impacts on the banking sector. I mean, it informs everything from market sentiment and macroeconomic stability on the indirect side to counterparty risk and market volatility at the direct end. Of course, volatility can be very good for banks, but other direct effects that geopolitics have are on regulations such as sanctions, export controls, investment restrictions, and import bans, and the processes and procedures that flow from these.
And if this is such a risk issue, then has it also caught the attention of worldwide regulators who are responsible for being alert to those risks?
Yes, I think in short, yes. This is something that we'll see a lot more of, an increasingly proactive stance of regulators when it comes to how banks manage geopolitical risk. And certainly in Europe, we're already seeing a move in that direction. The European Central Bank has identified geopolitical risk as one of its priority supervision areas for the coming years. And it's expected to demand more information from banks about their exposure to geopolitical risks. For now, the details about how this would work in practice are pretty thin on the ground, but the ECB is expected to increase requests for information about how banks are planning for geopolitical events and, according to some reports at least, conduct on-site inspections. So this may mean more geopolitical stress testing in general for banks, ensuring that they've got sufficient buffers, solvency and liquidity ratios to manage multiple and simultaneous crises. And of course, this comes off the back of concerns about further economic shocks caused by the wars in Ukraine, the war in the Middle East, the threat of rising trade conflicts following the US election, and pretty anemic growth in the Eurozone. So I think an increasing trend, we may see arisen is regulatory pressure to identify geopolitical risks and stress test against those geopolitical scenarios.
So that sounds as though this is something that banks really have to treat seriously and manage quite strategically and systematically. How is a bank typically organized to manage this kind of risk?
So in big global institutions, there's a huge amount of geopolitical expertise, but it's often scattered and siloed. Country risk teams have been around for decades, and they are typically where the geopolitical risk function is situated. But what we are now seeing is an effort to try to incorporate geopolitical expertise, both internally and externally, into other areas of banks in order to plan more effectively for a more dynamic geopolitical environment. And one area where we will see more of this is compliance. My own experience has been to create a function that looks specifically at the intersection of geopolitical risks with traditional financial crime risks. And geopolitics hasn't traditionally been a standalone area of focus for compliance, despite the fact that geopolitics obviously informs so much of what comes under the umbrella of financial crime. So sanctions, export controls, investment restrictions, import bans, or as we saw with the invasion of Ukraine, the oil price cap. But understanding geopolitical dynamics is crucial because ultimately what undermines the efficacy of sanctions or export controls or these other types of economic levers comes back to geopolitics. It's the willingness of countries to continue to do business with a heavily sanctioned state, to find ways to circumvent sanctions, and to facilitate cross-border payments. So it's axiomatic that the compliance departments understand these emerging coalitions, new trade routes, alternative payment systems, for example, and really effective mitigation requires geopolitical intelligence.
Yeah, what I found in my conversations with chief compliance officers and other compliance professionals is that it's certainly an area of rising interest, but banks have such visibility into so many different industries through the nature of their business, and also in some cases they have investment arms that maybe are catering to the needs of investors who are asking about some of these geopolitical issues. Do you think a bank's in a better position than other types of companies to manage these kinds of risks?
Yes. Given the breadth of their relationships, their counterparties across multiple industries, multiple jurisdictions, a particular advantage that banks have over other sectors is, as you mentioned, the access to so many different indicators. A global bank will, for example, know very early on if an economy is in trouble by looking at credit defaults, mortgage delinquencies, saving rates, for example. So they have many more reference points than other industries. And the same can be said for some early indicators of potential conflict or crises that manifest in economic or regulatory or trade indicators that banks have sight of.
So let's turn now to what some of these risks are. And we've had a whole lot going on in the world, risky events coming up, especially in the last 2 weeks, with what's going on in Syria and South Korea and the collapse of the French government and so on. Can you run us through a handful of these theaters of the world where you think geopolitical issues present a particular risk to the banking sector?
Yeah, I think all of those examples you just mentioned, Nick, really illustrate that we see a lot more conflict, a lot more instability emerging in the seams of these competing orders as the world shifts from this unipolar to a multipolar order. But really, for financial institutions in 2024, this year, the acute geopolitical issues were, of course, the war in Ukraine, the war in the Middle East, the US election, and then the longer term strategic issue being the US-China relationship. And of course, now we've had the re-election of Donald Trump, and how he responds to these conflicts will have a range of impacts on the banking sector in terms of markets, market access, and new legal and compliance pressures. I think, on Ukraine, Trump has nominated Keith Kellogg. He is a former national security advisor and retired general, and he's going to be special envoy to Ukraine and Russia. And he is expected to push for an accelerated ceasefire and negotiation process. There is a quite well publicized plan that he authored to encourage both sides to negotiate, essentially by telling Ukraine it will only receive more US weapons if it enters into peace talks, while Russia is simultaneously informed that any refusal to negotiate would result in increased US support for Ukraine. And he and other influential Trump advisors have argued that US priorities should shift to the Indo-Pacific. And I think if we look at the very hawkish stance of many of Trump's White House and cabinet appointees on China, there may be a policy to try and draw Russia away from China with incentives that could include sanctions relief. A caveat of this is, of course, that this could go the other way. Trump was very critical of Biden's drip feeding of Ukraine weapons rather than giving it what it needed to win. I think in terms of Iran and the Middle East, there is likely to be very significant pressure on Iran, given its weakening and its losses of allies and proxies with the fall of Assad last week and the neutering of Hezbollah. Iran may seek to accelerate its nuclear program, or it could potentially look to reach a new deal with the US. I think there'll also be pressure for Israel to end the war in Gaza. And on China, if you look at Trump's economic, trade, national security, and foreign policy appointees, a great deal of them have espoused, a very hard line on China. And you have a Republican control of the presidency, the Senate, and the House. So I think many of those Senate bills that were designed to contain China will pass through both chambers and potentially receive presidential sign-off. That was a lot of bills that were brought in September in what was known as China Week. So there may also be attempts to disrupt increasing cooperation between China, Russia, North Korea, and Iran, because these new interdependencies pose a fresh set of risks from both a supply chain and a technology point of view. And concerns are obviously rising around mutual exchange and proliferation in the West. So that will likely be an area of focus. But an important point to make about all of these conflicts is that so far the trend in the West has largely been to contain, not escalate. So avoid kinetic force and instead increase the use of sanctions, export controls, and other tools of economic coercion. So that is a trend that is likely to continue. But where that might differ potentially is in terms of proxies. So they may well continue to be militarily targeted. And we may, for example, see more action taken against the Houthis, finding a way to stop them from disrupting commercial shipping in the Red Sea. But really, the key message is that confrontation is a new systemic global reality. And I think it's clear it's here for the foreseeable future in many guises, whether it's a hybrid or direct. And all of this will have an impact on the banking sector.
I just want to remind the audience that if you have a question, you can write it in the Q&A field that you should see on the right-hand side of your screen, and we'll get to those later. But first, let's turn to the very, very closely related topic of sanctions. Rosamund, you touched on this already. Let's just run quickly through each of the main areas of sanctions and where there's been a lot of discussion. So if we could start with Iran, where there's been a discussion about returning to quote unquote maximum pressure in relation to Iran's nuclear program and its proxy wars that it pursues around the world. So this seems to be a focus for the Trump administration, doesn't it? Is this an area where we could see some change?
Exactly, Nick. I think that's exactly what we will see. I think we'll see a shift in US policy, maximum pressure with the goal of either containment of Iran's nuclear and missile development programs and its proxies, or potentially reaching a new deal with a significantly weakened regime in Tehran. So that's on the table. I think the events in Syria and Hezbollah's decisive defeat will, of course, have implications for how the US and G7 partners, their policy towards Iran evolves. But the chief aim of maximum pressure will, of course, be to choke off Iran's oil revenues. And one option for the US is the potential use of an act called the Stop Harboring Iranian Petroleum Act, the SHIP Act for short. And this was co-led by Trump's incoming Secretary of State, Marco Rubio. And what's particularly significant about this act is that it targets operators of ports and vessels that receive and transport Iranian oil products and the refineries that process them. So if you think who is consuming most of Iran's output is of course China. So if this act was enforced, then the focus would be on the small Chinese refineries that process Iranian crude. It would be on port operators, any China-based financial institution involved in the energy trade, but also that has perhaps correspondent activities with the US and European-based financial institutions. Aside from that, there will be a continued focus on the global shadow tanker fleet, which transports not only Iranian crude, but also Russian and Venezuelan crude. And I think in the EU and the UK, we may also see efforts to sharpen enforcement on Iran or even reinstate some of those sanctions that were relieved under the JCPOA nuclear agreement.
And sanctions on Russia, how do those figure into the possible foreign policy play that you described that would come via Keith Kellogg?
So I think if there is any form of sanctions relief, it's perhaps useful to think about what sanctions would be easiest to lift, and those would be Treasury sanctions, which tend to flow from the president's emergency powers. So maybe if there was any form of sanctions relief, might look to areas such as potentially financial institutions, maybe reverting some asset freezes on some banks back to sectoral sanctions, for example, or exchanges, or maybe relieving sanctions on some individuals. Commerce Department sanctions, on the other hand, are harder to unwind. So those existing restrictions on exports of dual-use goods that could aid Russia's military industrial base, I think, will likely stay in place. And then on energy, whether Trump would want to ease any energy-related sanctions or seek to remove the oil price cap, that really remains to be seen. And obviously other G7 members of the price cap coalition may not agree to that. So I think one of the questions that banks will need to look at and grapple with if this does indeed happen is regulatory divergence. There is a potential for a scenario where the US eases sanctions on Russia, but the EU and UK may decide to do the opposite and instead actually ratchet up sanctions pressure. So there is a risk, which obviously would be a big headache for compliance departments if there is a divergence, transatlantic divergence on sanctions.
Yeah, absolutely. When it comes to China, now, a lot of what's happening there is more in the export controls category, isn't it? And what's likely to be the future policy direction there? So
I think, Trump's made it, I think you're absolutely right on export controls, but I think Trump's made it very clear that his choice of tool is tariffs when it comes to China. So there will be export control focus and maybe a smaller use of sanctions. So some of those sanctions enforcement, if we start with them, could be potentially any links to the Russian military industrial base, links to Iranian military hardware sales, and those enforcement actions could be targeting companies, front companies, in China or Hong Kong, and then there could be human rights related sanctions enforcement. But in terms of tariffs, I think Trump has, he's threatened these enormous tariffs, 60% on Chinese imports and a further 10% if China fails to prevent fentanyl flows into the US. And there's also an interesting tariff, a sort of tax on maybe components. So not tariffs on where the items that are finally assembled emerge from, but on the components and where they come from. So Trump's threatened those tariffs, as well as a potential 100% tariffs on China or other BRICS countries which defect from the dollar. So in theory, he could undertake these under International Emergency Economic Powers Act. So he could do that on day one. But the question is how long and prolonged these sanctions would be, given their very obvious inflationary effects they would have. And so there is speculation over whether these are opening salvos with a goal to reach a trade deal ultimately, as there was, you'll remember, in 2020. But in terms of the other trends that I think we will continue to see, it will be export controls. And again, the focus will likely remain on high-tech, dual-use goods related to semiconductors, chips, AI, and quantum computing. And all of that, again, will be on national security grounds. And we'll also likely see some scrutiny from the Committee of Foreign Investment in the United States, so CFIUS, looking at transactions involving Chinese investment in critical US industries, and obviously that the outbound investment rule on certain Chinese-controlled companies will also be used. And in response to this, what we've seen is some increasing restrictions by China of some critical minerals and maybe some rules around their transshipment from third countries to the US. I think there were some reports around that today. And sitting here in the UK and thinking how the EU and the UK might respond, I think that's going to be another area that will be need to be carefully calibrated for these countries. Whether there's an appetite or an ability to follow a hardline economic and trade policy on China remains to be seen. So maybe we'll see calibration of increase of purchases of US exports, a lot more perhaps LNG, for example, with greater alignment with specific US-led trade policies and export controls on China. And of course, what does all that mean for banks? It's really, again, it's looking at the potential connectivity of banks' clients to export control violations, and for banks that might have clients that are involved in high-tech industries or the manufacturing of dual-use items, there are risks around violating export controls there. And for clients that may sell products into the US, they could be impacted under component tariffs, or the re-export of Chinese origin goods. And again, the penalties for this would be high. So those are some key risk areas for banks to think about.
Great. And by the way, there's a very good article in the Wall Street Journal today about China's response to US export controls and tariffs for any audience members who want to check that out. We have a question from Mario. Really good question here, Rosamund. See what you think of this. How can banks adapt to a fragmenting international financial system under geopolitical pressure? Does it mean that the banking sector will fragment as well? And he points out that HSBC recently announced that it has split its operations into East and West. Do you think, is that part of a trend?
Yeah, I think Mario has hit on a particularly underappreciated risk. I think that we are beginning to see a fragmentation, a sort of bifurcation of the financial architecture, and I think this is something that banks really need to be alive to. And if we look at the area of alternative payment systems, and actually the plumbing of the way that financial flows move, they are being potentially geopolitically driven. So if we think about the IMF and the World Bank, we already have the BRICS Development Bank, the BRICS Contingent Reserve Arrangement as alternatives to those. I mean, these are very nascent organizations. But what was very interesting was, if you were paying attention to the BRICS summit in Russia in October, the focus was on cross-border BRICS payment systems that would act as alternatives to SWIFTs, which of course numerous Russian banks have been removed from. And there was an interesting proposal that was submitted by the Russian Ministry of Finance, and it outlined a system where commercial banks would be connected via the central banks of BRICS countries using blockchain to store and transfer digital tokens backed by national currencies. So I think, people really was identifying a huge amount of flaws in this proposed system, but I think it has rung alarm bells, because you have a number of BRICS central banks who are developing central bank currencies, distributed ledgers for clearing and settlement. And then there are these efforts afoot to develop alternative securities settlements and repository services, and really technological innovation may rapidly accelerate these systems. So while we're in this very early stage of a potential bifurcation of the global financial architecture, it's definitely something that banks and companies should be aware of. It's something to prepare for, because it may accelerate. This could be a snowball. I think, the geopolitical environment will really determine the speed at which there is divergence in the global financial system. There's plenty of governance and compliance issues that would need to be thought about as this happened. But certainly, yes, a key focus area.
So we have a couple of minutes left, Rosamund. I wanted to get to cybersecurity, which is another risk that was fairly prominent in our research report. And there's a strong connection here with geopolitical risk, isn't there? How do you look at cyber risk from the perspective of your role? Well,
look, I think it's certainly the case that financial institutions are being targeted more frequently. If you think about the UK specifically, it's home to an enormous financial centre, and there's no doubt that a lot of the attacks that the UK weathers are targeted at the City of London. And because the financial sector is the backbone of our economy, attacks on it are particularly pernicious. So there's no doubt some of these are geopolitically driven. In Europe, the number of attacks on banks, I believe, has doubled since the pandemic. And again, these range from cybercrime to sophisticated state-sponsored attacks. Quantifying how many of those attacks are geopolitically driven is very difficult, because by their very nature, they're plausibly deniable. You have a hierarchy of attacks, whether they're state-supported, they're state-sanctioned, or they're benignly neglected by states. And this is an area where countries like Russia are involved in escalating these grey zone tactics, so misinformation, sabotage, and cyber warfare. So if you're sitting in a global bank, you're an owner of global corporate risk. This needs to be accorded serious consideration and investment.
And sadly, we have to leave it there because we're out of time. Although I would love to carry on talking with Rosamund about these fascinating and very important topics. Rosamund, thank you so much for joining us today and giving us the benefit of your insights. Thanks to all of you for joining us as well. And we hope to see you at the future webinars. As I mentioned at the beginning, these are monthly. We're covering a new sector every month. We'll be covering banking again 6 months from now. Also, check out the research. I think we'll be sending you the link to that. That also is part of a monthly series. So thanks again, and we hope to see you all again at future events.
Thank you.